Hi, I'm Jennifer Goodman, a realtor in Austin, Texas. I'm here today with Sean Andrew of Vista Lending. And Sean, we are about to debunk a myth that you need 20% for a down payment on a house. What do you have to say about that?
Well, only if you're buying an investment property. Investment properties do need 20% down. If we are looking at a primary residence, if you're a first-time home buyer, you can get in for as little as 3% down. The standard minimum down for everybody else is 5% down. And again, second homes is as little as 10% down, and investment properties are 20.
Okay, so I actually ran into this conversation Sunday, and my lovely friend may have called you already about this because she was under the understanding that she needed 20% down to buy now. And she said, I have $50,000, but I want to cut back my costs so that I can put money away and save so that, and I said, what do you mean? She's like, well, I need 20% down. I said, no, you don't. And you cannot, or very few of us cannot outsave the pace of the market and how quickly prices are fluctuating with our homes here in Austin, Texas. So can you walk us through, as a lender who does this every day, let's talk about the math and why you cannot outsave the price of inflation in order to hit that magical 20% mark, even if you wanted to.
Yeah, and it might be difficult without charts, but I think we can go kind of high level. The problem is this, and we hear it all the time, especially first-time home buyers. They're, for most parts, actually very conservative, very financial savvy, very educated. They do all their, especially the younger folks, do a lot of research online, and the thinking is, I need to save up more money for my down payment. And at a high level, that's logical, and it's very sound, and it's very safe. Again, conservative kind of thinking. The problem is that it's very difficult. I mean, when we're talking about percentages of home, it's almost impossible to find a $300,000 starter home in Austin, Texas these days. But let's just use that as an example. 20% down is $60,000, 5% down is $15,000. So if you have $15,000 now, how long will it take you to save up another $45,000? Well, just ask yourself, how long did it take me to save up 15? And for a lot of folks, that's years. I mean, it's a long time, and that's a big chunk of money. And so what you really have to do is kind of look at, here I am now, will this work for me now? Will it get me into the home that I want? Because the home you may desire now will not be the same home as it is in 2 to 3 years. And what I mean is, we have average appreciation, just let's throw 2020 and 2021 out of the window. Historic appreciation of 8% a year in Austin, Texas. Well, that $3,000 home is now $325 next year. After that, it's $350. So if you're trying to chase a down payment and chasing value to do that, it's very difficult to ever get there unless you get an inheritance, you win the lottery, you get a giant bonus through your employer or something that puts you in that position, which is awesome, but for 95% of us, that's not going to be the case. So when I talk to clients with that, we try to break it down and really just look at the numbers, with 5% down, and here's what it looks like, and where rates are. And so there's two components. If value goes up 10% and rate goes up 1%, then the amount I qualify next year is 10% less than I qualify for now. So if I'm hitting my limits in a $350,000 home, and next year that home is $375,000, I don't qualify for that anymore. So I'm a bird in the hand kind of guy. Real estate is probably, and obviously I'm biased, I've been in this industry for 22 years, but I'm invested in stocks and probably some bonds. If I looked at my 401k, there's no doubt that my real estate has been the best investment I've ever made. So I try to just show people what it looks like now and the opportunity that might bring them. And it's all about where are rates, what is appreciation doing in your market? Not all markets are equal. I don't live in, I don't know, outside of Cleveland, Ohio. But I know what Austin does. I know what it's done over 20 years, and specifically really since the housing collapse of 08, 09, I know what it's done. And it's been a net positive to everybody that's bought real estate over the last decade.
So if you don't put 20% down on your first property, do you need mortgage insurance?
Well, yes, but no. So there's some options. For most folks, mortgage insurance makes sense. And there's a lot of misconception. Oh my God, I don't want mortgage insurance, because in the mind, it's like a car payment. It's $300, it's $400 a month. In most cases, it's not. Insurance is a risk-based product, just like our homeowners, just like our auto. If you're a good driver, you have lower insurance premiums than somebody who's been in 3 wrecks. So mortgage insurance rate works the same way. How much are you putting down? What's your credit score? And it gives you a factor of what that might be. Someone with a lower credit score with less down is going to have higher mortgage insurance than somebody with a little more down with a higher credit score. So it's tiered. 5% down, 10% down, 15% down, all have different factors tied to your credit score. In many cases, with a 10% down, I just priced one this morning, on a $350,000 loan, the mortgage insurance was $35 a month. So really, are you going to wait to save up another 10% or $35,000 to save $35 a month? Another thing most folks don't understand about mortgage insurance is it goes away. It's temporary. Once you bridge that gap and you have equity, so value has risen over time, loan amount has decreased because you paid on it, you can request your mortgage insurance to be dropped. The standard rule is it has to be in place for 24 months, 2 years, and then you can request it to be dropped. And that's where your clients actually need to reach back out to you, not me. I'm always glad to help, but you could actually run some comps and say, hey, we closed 2 years ago. I think your value's here. They look at their loan balance. If it is at 22% equity or a 78% loan to value, the mortgage insurance company can drop the mortgage insurance. Now, it automatically drops off when your amortization schedule, or the balance of your loan at a given point in the future as you paid it down, reaches an 80% loan to value. And for most folks, depending on how much you put down, that's 7 to 10 years. 3%, 5% down, probably closer to 10 years. 10 to 15%, probably closer to 5 to 7.
So Sean, with that said, when you have mortgage insurance, can you buy it down?
Yeah, so that's actually referred to as lender paid mortgage insurance.
Lender paid?
Lender paid.
Okay.
Sorry, So that is a function of interest rate. So basically what happens and the way this all works is at different rates, lenders get paid different fee, but the regulations don't allow me to make more fee. I'm kind of set, my comp is flat. And so what happens is by going up in rate, we make more money because that loan is more valuable to Fannie Mae or Freddie Mac at the higher rate. And we use that extra funds, that extra revenue to buy out the mortgage insurance premium. And so it's a function of, in most cases, it's about a half a point. So if rates stay were 3% with mortgage insurance, we could maybe look at 3.5 and buy out that mortgage insurance completely. Again, what we have to look at is what makes the most sense. I mean, if it's $75 a month, is that better than accepting a 0.5% higher interest rate over your loan over time? For most folks, when I've done lender paid MI, they're short-term owners, meaning they know they're only going to live in the house 3 to 5 years. And so it makes more sense to accept a higher rate than have the higher monthly payment. And that's the way. There used to be buyer paid MI. The industry did away with that because different lenders were doing it all kinds of different ways. And so they kind of transitioned into the lender paid model where it's kind of tied to the interest rate. It's a little more of a level playing field. Meaning some lenders were saying, okay, you can buy it out for $10,000. And others were saying, well, you can buy it out for $3,000. So they were kind of just making it up, and it was a bit of a shell game with the client.
Wow. Good to know. And I like the way you, again, like you're always good about making distinctions, and this is important. So if you are a homeowner and this is your principal residence and you want to use money one way and pay down, it may make sense to pay it down more quickly or not. And then if you're an investor, then again, it may make sense to pay it down more quickly or not. It's really a matter of how to allocate your funds and your cash flow to best serve your life, is what I'm hearing. But there's more than one way to do it.
Absolutely. Agreed.
So it could be if I got a Christmas bonus, if I don't even know if that's a thing anymore, but could I take a lump sum and just say, hey, I want to buy this down?
The mortgage insurance?
Yeah.
Potentially, yes. Again, most cases, they want it to be in place for 24 months,
Yes.
period, no matter how much you put down. But after that, if that got you to that 78% loan to value, you could absolutely do a principal reduction. That's what it's called, lowering the principal balance of your loan. And if it got you below that 78%, then the mortgage insurance could drop off.
Okay, so I could go in, I could buy a house for 3% or 5% or 10% or any number that is not 20%, get mortgage insurance, pay that for 24 months, and then reassess at that time. So as a realtor, it would be good for me if I had clients buying their homes to mark that in the calendar to remind them that, hey, you can buy this down.
Absolutely.
Okay,
the
I love
last
that.
piece on mortgage insurance, I think I bring up, I'm sorry to interrupt, but a lot of people don't know, mortgage insurance after the housing collapse, it was written into the tax code that it's tax deductible. Same as your interest you pay, property taxes, and homeowners insurance on your income tax. Mortgage insurance is deductible too. So there's some tax benefits to having mortgage insurance. It's hard to call it a benefit because it is money, obviously you're paying out, but you do get to deduct it from your income tax. So that $50 a month after tax deduction may be more like 40 bucks a month or 35 bucks a month once you recognize the tax benefit at the end of the year.
So some people may choose to use mortgage insurance as a savings plan. Whereas others might look at it as an opportunity cost, saying I could take that same amount of money, put it in another investment, have a return. And so then you have to weigh the balance of the cost of, so to speak, of where you're putting your money. Okay, I love that. Well, thank you. So for those who have tuned in, you do not have to put 20% down payment on your primary residence. So, hey, what about it? Thinking about buying a house? Have you been thinking about buying a house? Have you been thinking about giving your kids money for a house? Whatever that looks like, please feel free to reach out to myself or Sean. We're here to help. Our information is going to be at the end of this. And thanks for tuning in. We will catch you on another episode talking about mortgages. Thanks for tuning in.